country's saving also goes up. We also increase that country's net export balance, which is the same as its net foreign lending. And if we happen to have been a deficit country, we would be reducing our net foreign borrowing. Okay, so finally, or not finally on large open economies, let's think about this increase in autonomous investment example that we've been working with. And here, we already know that the desired investment curve is going to shift to the right. And once again, the next step is to think, what the dickens happens to the real world interest rate? Remember, it's an endogenous variable now. Again, if we're thinking about this on a global basis, nothing happened to the global supply of loanable funds, but now we have an increase in the global demand for loanable funds. So at any given interest rate, the demand is increased relative to the supply, and that causes the real world interest rate to increase. All we need to figure out is how much. And we can figure out how much because we know, I hope we know by now, that it has to increase enough so that the net foreign borrowing of one country is equal to the net foreign lending of the other. So the real world interest rate rises. Notice that investment increased. That was our change in autonomous investment. Our saving increased. That was our change in the real, caused by the change in the real interest rate. And now, our net export surplus has changed. We still have a surplus, though. Investment increases, savings increases. Unless you know the order of magnitude, you don't know whether net exports went up or down. Looking at the shock economy, the U.S. But if we look at the rest of the world, we see that that increase in the real world interest rate caused saving to increase and investment to decrease, and therefore net exports, the net export deficit got smaller. Yes?
How would you know that you passed the threshold of the IMS remote where it was switching your budget deficit to a surplus?
Not budget, net export. Okay. So the question is, could this switch, could the increase in investment be so large to change this country from a net exporter to a net export surplus to a net export deficit?
Rather, the question is, I have but the question is, how do you know how much happens?
Okay, so your general rule of thumb on that case is never change a country from a net export surplus to a net export deficit. Because if you want to do that, you need to draw both countries' curves exactly right. Because remember, in a two-country world, if one country goes from being a net export surplus country to a net export deficit, the other country has to switch from net export deficit to net export surplus. So we rarely see that happen, at least in large open economies. Okay, so here what we can see then, again, an increase in desired investment caused the real world interest rate to rise, increase the country's desired saving. By the way, it'll also increase the country's desired investment. That's the shock that happened. We reduced our net export balance. Our surplus got smaller, which also means that we reduced our net foreign lending. And from the rest of the world's perspective, we also reduced our net foreign borrowing. Had we been a lender to begin with, a borrower to begin with, had this shock happened in the rest of the world, we would have to increase our net foreign borrowing. So again, in your copious free time this weekend, hey, there is no football game that we care about. Okay? So a couple of things you want to probably think about. Take your small open economy and think about, we did it with a world interest rate above the rate at which savings equals investment. Think about it with a low interest rate. Here we did shocks in the U.S. economy, which was our net export surplus country. Work out how the shocks would be if they had happened in the rest of the world. Right? Make sure you understand what's happening, whether the shock occurs, whether the country has a surplus or a deficit. Oh, by the way, and do your problem set too. And read chapter 6 for Tuesday. And it's going to be really hot this weekend. You want to be inside where it's air conditioned anyway. Okay, so now the other thing to keep in mind about the kind of shocks that we've looked at, everything that we did on Tuesday and that we've done again today, we've only looked at a single shock. Right? And in fact, we kept the single shock all the way through our example. Okay? In the real world, it's unlikely that a single shock will happen. So think about the following. This weekend is the 6th anniversary of the failure of Lehman Brothers, and therefore the onset of the really catastrophic portion of the financial crisis. Okay? What happened? Well, several things happened with that. One of the reasons for the collapse in the financial crisis to begin with was that housing had been in a boom, and that boom busted, right? And everything came tumbling down. Remember, building houses is part of investment. Autonomous investment collapsed. Whoosh, right? The demand for loanable funds curve shifted far to the left. At the same time, business executives got really panicked and decided, I don't know what's going to happen. Business confidence goes way down. There's a big increase in uncertainty. You think I'm going to borrow a lot of money to expand a factory? Not going to happen. So now, autonomous investment falls again. The investment curve way to the left. What happens on the other side, the saving side? So several things actually happened. First, consumers, households, got really scared and started to save a higher percentage of their disposable income. If you go back and you look at some of the charts that we examined on Tuesday, you'd see that the personal saving rate went up. At the same time, the government cut taxes and increased government purchases. So the government saving rate went down. So we had all sorts of things happening to the saving curve. Some shifting it to the left, some shifting it to the right. The net effect, however, was the big leftward shift of the investment curve. Demand for loanable funds on a global basis fell compared to the global supply of loanable funds. What would happen in that environment? The real world interest rate would fall. Guess what? Today, 6 years later, the real world interest rate is really low, much lower than anything that we had seen prior to the crisis. What's going to cause it to come back? You've either got to have less saving or more investment, or some combination of the two. But that's pretty much it. How do we get there? Okay. Another way of thinking about this model that we've done, suppose you're really worried about the fact that the U.S. has a very large net export deficit, or you're really worried about China having a very large net export surplus. Okay? This model will tell you what has to happen for those surpluses or those deficits to get smaller. Okay? It all has to do with national saving, how much saving takes place inside a country, and domestic private investment. What does investment demand look like? The capital flows, and therefore the trade balances, come after we've made saving and investment decisions. Net exports is a residual in all of this. It's not the driving force. Saving decisions, investment decisions are the driving forces. What they do are going to determine what's going to happen to international capital flows, financial capital flows, and therefore net exports. Now, the one thing we haven't talked about, though, is how do the funds that are saved actually get to the borrowers? Right? So remember, to be a saver, you actually have to have spending, current spending, less than your current income. Right? That's what we mean by saving. To be a borrower, you want to spend more than your current income. So somehow we need to get the funds from the people who are saving to the people who want to borrow. That's the role of the financial system. And most of the time, the financial system simply sits in the background doing its allocation issue, channeling those funds from savers to borrowers. And every now and then, like 6 years ago, the financial system blows up. And then we have a real problem. And the aftermath of financial crises never looked good. So I don't want to talk about the financial crisis now. We'll talk about that later, and we'll see why things have turned out as badly as they have. But let's think about how this flow of funds gets channeled between savers and borrowers over time. So the first thing to notice is way over here down here, we have the people that are saving. So remember, savers are people who are spending less than their current income. And over here, we have the people who want to borrow. Right? And they want to borrow because they want to spend. By the way, if you have the first edition, it actually says borrower-saver, typographical error. Should be spenders. Okay? So the question is, how do we move funds from these people who aren't using all of their income to these people who want to use more than all of their income? And we have two channels that this kind of flows through, two big channels that this flows through. One is a very direct channel. Let's just take as an example, a business that wants to borrow money to expand. Right? Tesla is an example. Suppose Tesla wants to borrow a whole bunch of money to build a battery factory in Nevada. Okay? So how do they do that? So they can issue a bond. Right? So a bond is simply, I'll give you a piece of paper, which is a promise to pay you back, and you give me your money. Right? And the promise to pay back, that bond, basically says every so often, might be twice a year, 4 times a year, once a year, whatever, I'll make you an interest payment, and then at the end of the bond, which might be 10 years or 20 years into the future, I'll give you back your principal amount, the amount that you lent me. So notice that when Tesla does that, and you give them your money, Tesla now has your money, and they can spend it. That's good for investment purposes. Right? They also now have a liability. That piece of paper that you own that says they're going to pay you is a liability to Tesla. They've promised to pay you. You, on the other hand, have an asset. Right? That piece of paper is valuable. They're going to pay you interest every 6 months in principal at the maturity period. Okay? So that has value associated with it. You have an asset. They have a liability. Now, chances are, when you do this transaction, you did not actually talk to anybody at Tesla. In general, the way these types of transactions take place is that Tesla would use an investment bank here in the middle to actually contact customers who would be interested and find out who's willing to buy what and put their customer base together with the issuers, Tesla in this case, and actually undertake the transaction. So Tesla wants to borrow probably, let's say, $6.5 billion. That's what they think this factory will call. This $6.5 billion does not get included in GDP. However, we've got all these investment banks in here, the Schwabs of the world, the Goldman Sachs of the world, who are providing the service of matching the savers with Tesla. They get paid. That does show up in GDP. But the big part of the financial transaction does not. Now, the one risk that you're taking over here is that Tesla turns out to be a deadbeat. So we may find, for instance, that 5 years from now, after you've lent the money, that the flux capacitor has been perfected at the Berkeley National Labs. Oh, come on. Okay. Everybody knows the flux capacitor, right? Back to the future. Okay. So we perfect the flux capacitor, and electric cars go, right? Nobody needs lithium-ion batteries anymore. And Tesla goes, boop, belly up. Sorry, thank you for lending me your money, but guess what? I can't pay you back. Right? So you have default risk directly to Tesla. They go bankrupt, you're out of business, or you've lost your money. Okay? It happens. Greece has done it. The city of Detroit, Michigan is in bankruptcy. Companies fail all the time. The direct investors lose when that happens. Okay. There's a second way that this can happen, the way that probably most of us would be involved in, and that is rather than lend to Tesla directly, I put my savings in a financial institution or a financial intermediary. So I have my money in a bank account. I have some money in a mutual fund. I have money in a pension account. I have money in a life insurance company. I pay my premiums on all sorts of insurance policies, all those types of things. When that happens, I still have an asset. The asset is the financial institution's promise to pay me that money or those funds back. Now, what does the financial institution do? They go, great, look at this big pile of money. All these funds are sitting here. This is great. Let's just sit around and count it all day long. Right? No, right? They lend it out. And so what's most likely to happen is you're going to put your money into a financial institution. This financial institution is going to lend their money to Tesla. So they can build that battery factory in Nevada. Now notice what's different about this. If Tesla now goes bankrupt, the asset that gets lost is lost by the financial institution. The financial institution's liability to you is exactly the same. What the financial institution is hoping is that it can earn more money over here after defaults than it has to pay you to acquire your assets over here. Now, it can break down because financial institutions do fail. And we saw that in 2008 and 2009 a lot. So while your exposure is no longer to Tesla, it is to the financial institution. Now, here's the big difference between these two. indirect finance is basically giving you an insurance premium, selling you an insurance premium. The premium is you're not exposed to the ultimate borrower. But that premium costs you money. And the way it generally costs you money is by a lower rate of return. This is why banks don't pay you very much on your savings deposits. So it turns out indirect finance is more expensive than direct finance. As a country's financial markets develop and become increasingly sophisticated, we typically see a shift away from indirect finance and towards direct finance. So in the United States, direct finance is by far and away the most important source of funding. In China, it's relatively unimportant because financial institutions handle most of the transactions. Japan and Germany are somewhere in between. So this is kind of how our funds, national saving, gets to investment demand. You can look at all the other slides on your own. Have a great weekend. Don't forget problem set number 1.